Hey guys, welcome back to another week of Mortgage Matters in Minutes. Again, I'm your host, Brent Rasmussen here at Mortgage Specialists. And today we're going to be speaking about credit, what makes up your FICO score. And while this can be a very complicated question, we try to break it down and give you the facts here that would apply to all scoring models. And so we've been teaching this course, or I've been teaching this course over 15 years to local high school students, college students, university students, anybody that wants to become educated on the true facts of what breaks down your credit score. And today I'm going to give you those so you have a chance to understand exactly what it is that makes up your score and how you may be able to focus on a category or two to improve your credit score. Because much of the time when it comes to getting a mortgage, credit is one of the first things lenders are going to look at. Same with car loans, student loans. Anytime you're borrowing money, we're going to be looking at the facts there of your credit score and how that's impacted in order to borrow money moving forward. So we're going to kind of do a quick share screen here today. This might take a little bit longer than normal, but this is a FICO score pie chart. And this is what we show a lot of our clients that want to become educated on why their score is where it's at or how to become better. And you can see it breaks down all these percentages equal to 100%. But if we look at the two most important scores, 35% is based on payment history and go down. 30% amounts owed, they're in the green. 10% on gray, new credit. 15% based on length of credit history. And 10% based on the credit mix itself. So what we first like to speak about always is what impacts the credit score the most. Obviously, it's payment history being 35% of your score. And the payment history is basically simple. You pay your bills on time or early, that will give you a good score. If you miss your payments, you become late, they turn into collections, judgments, or anything negative, that is most drastically going to affect your score. And obviously, the more recent the late is, the more that is going to be impact on your score. Where if something happened 5 years ago versus 5 days ago, those are two different time increments based on your credit. And the more recent the score, the more recent the late is, or the more recent the collection item, meaning you didn't pay off the account, or it goes into a judgment, meaning that the courts awarded that you were owed money, which maybe it also turns into bankruptcy or foreclosure. Those are going to be the greatest impact on your score. So while you might not have received your statement or something else happened in your life that you weren't able to get that payment in for, that is the most impactful to your credit. So when clients call me and they've had multiple lates, and I tell them they ask, what can I do to fix my score? I might tell them, well, the first thing you have to start doing is getting all of your payments in on time regularly to have no late payments that show up on your credit report or delinquencies. There's a lot of words that we use to make that happen. The second most important portion, or in this pie chart, the 30% there is the amount owed. And that's based on credit cards and lines of credit. And what we look at, or what the credit scoring models look at, basically FICO score here, is that 30% of your score is based upon how much your balance is in relationship to your credit limit. And while many clients don't know what their credit limit is, it's easily looked at on the credit report. It'll show the max credit line that you have, and we also see then the balance. So one of the easiest ways and fastest ways to fix your credit score is to pay your credit cards down or completely off. There's different tiers that once you get above on your credit card, that your score will start to drop. And so let's just talk about maybe a credit line of $1,000. As we get above 10% or $100, your score might drop a little bit. Next tier is 30%, so a $300 balance. Then it goes to 50%. 70%, 90%, and 100%. Generally, those are the tiers that the credit score looks at. So if you have a $1,000 credit limit, it's best to keep it down to 0 or below 100. 30%, again, is the best bang for the buck. If you can keep it below that $299, $300, that is going to be great. But if you are a newer credit user compared to someone that's had credit history for a long time, it might impact it a little bit different. And do note that every credit report is going to look and feel different. Every person has started credit differently, started different credit accounts, opened and closed accounts at different times. So there's going to be no credit report that's nearly exactly the same. They're all going to be different with these different percentages that occur with the score. So the first two I always like to speak about: pay your bills on time, keep your balances low on credit cards. If you can do those two things alone, that makes up 65% of your score. Next, if we just kind of go continually clockwise in this pie chart here, 10% of your score is based on new credit. And a lot of people get very defensive on this section, or don't want companies to pull their credit report, because this is what's called credit inquiry. Someone that's obtaining your credit to give you credit has to obtain your credit report and review it. That's called new credit section. And 10% of your score is based on how many credit inquiries you've had, meaning how many people have obtained your credit and reviewed it. And the other section then comes out to being, did you open credit after you actually had a credit inquiry pulled and reviewed there? So I don't think it's an enormous deal that you have your credit pulled, as long as you have good credit and you're opening credit shortly after that time frame. If you're just having your credit pulled randomly over and over and over, or you have your credit pulled and you become denied for a credit loan, that's when the credit report will drop your credit score, because it states, hey, you went and looked for different credit. You've had people look into your account, but you never obtained credit. Maybe you didn't qualify. Maybe you had a low credit score or something like that. So that's kind of a touchy one that we have to look at on a case-by-case basis to see how impactful it is for your credit score and history. If we continue next here in the light blue section, length of credit history. So 15% of your score is based upon how long you've had credit. And some people say this might be discriminatory, but the more information we have, or the more data we have on anything generally, the more likelihood that we can predict what's going to happen. So someone that's 40, 50, 60 years old obviously should have more credit than someone that's 20 or 30 years old. And because of that 10, 20, 30 years of credit history, we can give a better understanding of how their time went. If they had no lates, if they kept all their balances down, if they've done all the right things over 30 years, it's probably going to continue that way. But if they've had bumps in the roads along the way, that could be less likely that they'll grant credit due to the score being low if you've had some problems along the way. So how long you've had credit open is 15% of your score. So I generally always advise clients, once you open up a credit account, if it's a credit card, generally you want to keep it open. There could be different reasons why we would advise you to close a credit account, but generally if you've had one open, if you're not paying any annual fees, it's generally a good idea to keep that account open, because the longer you've had credit accounts open, obviously the better it is for your credit score. Last here is 10% called credit mix. And what is credit mix? Really, that comes down to what kind of balance of credit accounts do you have on your credit report? Do you have all mortgages? Do you have all car loans? Do you have all credit cards? Do you have all store cards? Those are all different kinds of credit accounts. And generally what the credit reports like to see is that you have a good equal mix, balance in credit accounts. I can't tell you exactly what that mix is, but I can tell you if you have a mortgage or two and you have a car loan, you have credit cards, if you have a good amount of each one, that's great. Generally, I advise clients to have anywhere from 2 to 5 credit accounts, credit cards. Car loans not necessarily required by any means, but if you have 10 car loans and no credit cards, no mortgages, that could be a problem there. Or if you have 10 mortgages and no car loans and no credit card, that also could be not a good mix. They want to see they have the ability to use credit to benefit yourself in case of emergencies, and to show the payment history that you have been able to pay off accounts throughout time as well. So if we look at each one of these categories, when we look at an individual credit report, we can generally give you the best advice on giving you, saying, hey, this category is affecting you here. But again, without seeing each individual credit report, it sometimes can be hard to give you the exact advice on what to do. But we can look at this pie chart, and if you look at each one of these categories and look at your own credit to determine how can I do better in that category, that definitely will get your credit score up. I know throughout time here, there's lots of questions that come up with credit. We're always here to help advise and answer any particular credit question that you may have. We generally like to see a copy of the credit report or a credit history to see where we can give you the best information and where to move forward. But I would tell you most of the time, we're always going to fall back to this pie chart of looking at these categories. And generally the two most important in this, as we have stated, is payment history and keeping your credit card balances low. If you just do those two things alone, your score generally is going to stay fine. Obviously, to get the best score up in the 800s, you want to focus on the last three categories of having low credit inquiries, a good credit mix, and having credit open as long as possible. So this is a great, just basic information on looking at what your credit score would look like in a maybe neutral environment, starting off credit and building credit to make sure you're doing the right things, or if you had credit problems, how to fix them, or if you have perfect credit, how to keep it in that particular avenue of the best scenario possible. So here at Mortgage Specialist, we can always be reached just a phone call away at 402-991-5153. You can check us out on our website at mtg-specialist.com, or you're always a click away on Facebook, Instagram, and Twitter, and we will see you guys all here next week. Have a great one. Mortgage Specialists. Driven, trusted, reliable.